financial company. If you are looking for English English videos, English language videos of entire content of JIIB, you can WhatsApp me on the number shown on the screen in the description section. We have complete lecture available in English for the entire subjects, all the 4 subjects of JIIB. So let's get started with our unit number 25. So basically these are the topic which we are going through. First of all, we will see the objective, then introduction, what is NBFC, how NBFC evolve in India, what is the role of NBFC in promoting inclusive growth on India, who are the regulators, what are the classifications, what are the types, what are the regulatory oversight by RBI. So basically there are 13 topics. So we will try to cover in 2 types, two videos. So in the first video we will try to cover till 25.8 and rest 25.9 to 25.13 we will cover in the next video. So let's get started with our first topic, that what basically is NBFC or non-banking financial company. So friends, have you ever heard of NBFC? Basically it stands for non-banking financial company. You can think of it as a financial firm that work like a bank. Yes, they work like a bank, but it's not actually a bank. They are not actually a bank, right? Because it provide you loan, it provide you investment, right? They provide loan, it provide investment. They also provide, other money related service, right? Especially to people and businesses that traditional bank might ignore. Yes, right. The major point is that it provide loan, it provide investment, it provide money related services, right? Money related services it provide to whom? To people and business that traditional bank ignore, right? That traditional bank ignore. There are some services that traditional bank ignore. To them, this particular NBFC provide loan, investment and other money related services. Now what does it do? Let's see. First of all, they are alternative to bank, right? They are alternative to bank. First of all, not everyone can get a loan from bank easily, right? Maybe the paperwork is too much, okay? Or suppose a business, it may be that business is too small. That is where NBFC steps in. Okay, so those people who are not serviced by bank because of high paperwork or because of business is very small, NBFC steps in. For example, a small shopkeeper is there in any village. He might not have proper document for a bank loan, but he can get some fund from NBFC. This is the first point where NBFC help. Second point, they help remote and underbanked area, right? So remote location, underbanked area. Okay, so for example, bank may not reach every corner of India, but NBFC often reach there. For example, a farmer in a rural area, they might get a loan from NBFC to buy equipment when no branch is there nearby. Third point is that it supports the weaker section of the society. So basically they help the low income group, LIG, LIG, low income group, or small businesses, or people with limited banking access. So basically they help people within the weaker section of the society. For example, an auto rickshaw, right? An auto rickshaw driver might get a loan from NBFC to buy his vehicle when bank reject him. Bank may reject this auto rickshaw driver, but he might get loan from NBFC. Then NBFC offers, so all 3 points already I told you. First of all, alternative to bank. Second point I told you, remote location. Third point I told you, weaker section of the society. And the fourth point is that the NBFC provide financial service without a banking license. Yes, no banking license is required. NBFC can't take deposit like bank. Yes, they can't take deposit. Remember, they never take deposit like bank. But they offer, what they offer? They offer loan in advance. They offer insurance. They offer leasing. Yes, leasing they also offer. Like, what is the meaning of leasing? Like, renting machinery. That is leasing. They offer hire purchase. What is hire purchase? Hire purchase, this is called payment in installment. There is a separate chapter on leasing we will cover there. So leasing means renting machine. Hire purchase means you are paying in installment. Chit fund business, group saving scheme. What is chit fund? This is like, group saving scheme, right? So these are the point. So basically, they can't take deposit like a bank because they provide you financial service without banking license. Now have a look at key difference from bank. Yes, what are the key difference of bank? How they are different from the bank? So first point is that no demand deposit. Have a look at it, right? So I think this is a repetition. Okay, we have already covered it. Yes, So no DD, no demand deposit. You can't open a saving account in NBFC. First point. Second point is that there is more flexible. NBFC is more flexible as compared to bank. Means easier loan approval, especially for a small borrower. They fill the gap. Filling the gap means what? They serve those left out by traditional bank. Now the question is, why are NBFCs so important? Because they boost financial inclusion. They help a small business grow. They keep money flowing in place where bank don't reach. So what we learned from this discussion is that, let us summarize the fact. We come to know that NBFC is called non-banking financial company. Okay, they work like a bank but is not a bank. They provide loan and financial service. I told you they provide loan and financial service. Second thing, they help small businesses, right? They help small businesses and rural area. Third point, they can't accept deposit. Remember, NBFC can't accept deposit, right? And they are regulated under the Companies Act. This thing you must know. They are regulated under the Companies Act. Okay, I hope that makes sense to you. Now friends, have a look at the next slide. So NBFC plays a bigger role in India's financial system, but their unique and complex operation created a need for better rule. Yes. So basically unique and complex operation created need for what? Better rule, right? Better rules to protect people's money. Obviously, regulatory mechanism is required to protect the people money. So over the time, RBI stepped in to regulate them. So why did NBFC need regulation? So the question is, why regulation? Why regulation was needed? So in early day, what happened? That limited RBI control. In 1960, if we talk about, they were limited RBI control. Initially, RBI has very little power over NBFC. Only deposit taking NBFC were lightly regulated. But there are some deposit taking NBFC also, so they were lightly regulated. For example, if an NBFC took public deposit and failed, people lost money with no safety net. Then comes a committee. You must know the name of committee, like Maligram committee we have discussed in the earlier slide, in the previous lecture, in the previous chapter. Here the committee name is James S. Raj Study Group. This question is asked. This committee was formed in 1970. So they recommended rule for hire purchase and leasing NBFC. I told you now that NBFC has a bigger role in hire purchase and leasing. So when we talk about leasing, what does it mean? It means renting machinery. When we talk about hire purchase, it means you are paying an installment, right? So for those NBFC which are engaged in these two activities like hire purchase and leasing, right? So this James S. Raj committee recommended rules for these two companies. He says that they could only accept deposit up to their NOF. Right. So hire purchase and leasing company could accept deposit up to their NOF. NOF means net owned fund, right? Like their own capital. That is called NOF. And they had to maintain liquid asset like government security. They have to maintain liquid asset for security. For example, if NBFC has 10 crore in NOF, it could not take more than 10 crore in deposit. They recommended that hire purchase and leasing company, they could accept deposit to the extent of their net owned fund, right? And also they had to maintain liquid asset. So can you give me some example of liquid asset? Like government bond. This is example of liquid asset. They have to maintain liquid asset for security. Let me give you one example to make it more clear. For example, suppose an NBFC has 10 crore in NOF, net owned fund. Right, so it could not take more than 10 crore in deposit. It could not take more than 10 crore in deposit. That is the point. Now, then comes boom in NBFC. You can see that from 7,000 to 30,000. So many new NBFC opened, some risky, some fraudulent. People invested without knowing the danger, and some NBFC promised higher return but vanished with investor money. Then another committee was formed. The first committee was James Raj Study Group. Two things recommended: that hire purchase and leasing company could accept deposit to the extent of their NOF, and they should maintain the liquid asset, right? Then the second committee is SAH committee. So SAH committee was formed in 1990s, right? Remember, SAH committee was formed in 1990, and there were strong measures. So they recommended compulsory registration. First of all, they recommended what? Compulsory registration. What does it mean? That no more fly by night NBFC. right? Some NBFC, they fly by night. So registration was made compulsory, and then prudential norms were introduced, which means stricter financial discipline. For example, like getting a license, suppose you are opening a school, so you must get a license, right? So like getting a license before opening a school, NBFC now has to register with RBI, right? That was the recommendation of the SA committee, which was formed in 1990s. Then in 1997, what happened? That a major regulatory changes were there. That RBI got more power to supervise NBFC in 1997. Stricter rule on capital, risk management, and transparency. Now, basically, for depositor protection, it is very important. For making NBFC more trustworthy, it is very important. So let's summarize the key point which we have just covered now. First aspect we have talked about is that little regulation. Early there were little regulation, right? Then we talked about 1970, where James S. Raj committee was formed, right? So they set limits, and also deposit. I told you that the deposit should not exceed the NOF, and also liquid asset. They account for liquid asset. Then in 1980s and 1990, I told you that it boomed. NBFC boomed. Then SA committee was organized in the year 1990, and SA committee recommended registration. SA committee recommended registration and strict rule. And 97, what happened? That RBI tightened control. So these are the major breakthrough that NBFC has gone through. Now have a look at the evolution of NBFC in India. So friends, ever wondered how NBFC becomes such a big deal in India? Let's take a quick trip back in time to see how they started small, grew big, and become a key player in Indian financial system. If we go back to the early day, which is 1960, so a bank back then mainly served big business and city. Yes, bank were more focused on big business, right, and cities. Many small saver, investor, business were left out. NBFC stepped in to fill this gap. So what NBFC did, that they collected FD from regular people. Okay, and then mini bank. Okay, and then provide the leasing service. Yes, they were engaged in what? Leasing service. Providing machine renting. Whenever I say leasing, it means renting equipment, renting machine to the company. For example, a small factory is there. Suppose a small factory is there, right? They could lease a machine. A small factory could lease a machine from an NBFC instead of buying it outright. So that is one service of leasing that NBFC used to provide. So a small factory has to get a machine. There are two options available, either to buy it or to get lease. So they opted for leasing, right? So that is the service which were provided by the NBFC. Now, earlier there was limited impact. So you can see not much more impact. So we can say that the impact was limited. So earlier there was limited impact, right? So operation were small scale, not as powerful as bank yet, right? So basically the impact was very limited because operation were small scale and they were not as powerful as bank yet. Then comes the growth phase. So early phase was very small, the impact was very small scale. Then comes the next phase, which we call growth phase. Growth phase was 1970 to 1990, right? So problem was that there were no strong regulation. Problem was that no strong regulation was there, right? So initially only the Company Act loosely controlled them, right? So NBFC were regulated by the Companies Act. Okay, so initially only the Companies Act loosely controlled them. Some NBFC took public deposit but has no safety net for investor. Okay, so the growth phase was 1970 to 1990. Problem was that there were no strong regulation. Initially only the Companies Act loosely controlled them. Some NBFC took the James Raj committee, which recommended that NBFC could only accept deposit up to their net on fund. Okay, main problem was that there was no strong regulation, right? And also James Raj committee suggested that they have to keep liquid asset as backup, right? They have to keep liquid asset as backup. For example, if NBFC has 5 crore capital, it could not take more than 5 crore in deposit. I told you earlier. Now in 1990, there were some big changes, right? RBI got more control over NBFC, right? RBI got more control over NBFC in 1990s. And compulsory registration and stricter rule were introduced. Compulsory registration in 1990s it was introduced. Earlier there were no registration requirement. Now the question is why this evolution matter? Because it make the system more trustworthy, because if rules are strict, right, a scam will be fewer, right? If rules are strict, a scam will be fewer. And it encourages the financial inclusion. Inclusion is encouraged by this thing. So it reaches people, those people which the bank ignored. That is called financial inclusion. That's why this rule comes into picture in 1990s. And it offered diverse services. Like today they offer loan, insurance, leasing, and more and more. So what we come to know, just summarize the fact which we have just covered in this slide. 1960, NBFC began as alternative to bank. Okay, early work that they took deposit, right? They provided leasing. This is where the early work. And then in 1970, I told you there was a committee which was called James S. Raj Committee, which set limit at deposit, how much deposit it can take, and there are some safety rule. Then in 1990, RBI, what RBI does? In 1990, RBI tightened control. Yes, RBI tightened control regarding registration and stricter norm. And today, NBFC is a crucial part of Indian financial system. Now, friends, let's come to this particular slide. Yes, between 1980s and 1990. Have a look at this. So picture this. In the 1980s and 1990, NBFC in India exploded from 7,000 to 30,000. I think we have discussed this already, right? And we talked about rapid expansion, because more NBFC means more option. But the risk, the fraud risk also increase, right? Because some shady NBFC promised higher return, okay, and vanished with people saving. And then comes another committee. I told you about Shah Committee. Shah Committee was formed in 1990, right? Shah Committee was formed in 1990. Okay, so basically it is also called the rule maker. This committee is also called the rule maker. So RBI appointed a committee to clean up the sector. And what was the key recommendation of the Shah Committee? That yes, it made compulsory registration. Remember this key point. It made the registration compulsory. Means no more fake companies should be there. And prudential norms, which means maintaining minimum capital. Just like you need a license to drive, similarly NBFC now need RBI approval. Then come 1997. Then this was the big regulatory shift. Means RBI got a stronger power to supervise NBFC. Then the part 2 is the role of NBFC. Role of NBFC in promoting inclusive growth in India, right? So basically, what is the role of NBFC in promoting the inclusive growth in India? Have a look. So first of all, NBFC emerged as the heroes of financial inclusion. Yes, this is a very, very important point. Financial inclusion. So basically, it is about reaching the unreached. So basically, what happened, that bank often ignored the rural and semi-urban area. Bank ignored these area. Rural and semi-urban area. For example, a farmer in Bihar, he gets a loan from an NBFC to buy seed. When a bank say no, bank clearly reject. That bank say I can't give you loan for buying seeds, but NBFC say yes, I will provide you. So this is called reaching the unreached. Okay, and that is what we're talking about this particular paragraph. And then innovative product. Yes. NBFC also come with some innovative product. So let me give you some example of this innovative product. Like they tailored loan for a small business, micro entrepreneur, and low income group. Okay. So that is called innovative product. Let me give you one example. For example, a street vendor, right? A street vendor gets a small ticket loan. This street vendor gets a small ticket loan, right? And to buy a cart via NBFC app. So he can buy a cart via NBFC app. that is street vendor. Then that is called innovative product. Next point is healthy competition for bank. Yes, healthy competition, which means NBFC force bank to improve service and to lower rate, right? So because of NBFC, bank now offer faster gold loan at competitive rate. And finally, there was a tech driven solution. It offered trade driven solution, which means use of application, digital lending and paperless process. So you can get a personal loan in 10 minutes via NBFC app. So basically, why does this matter? Because no more loan shark. Regulated NBFC, it means safe borrowing. Second, it support the grassroots economy. Yes, what we are talking about is the grassroots economy. It helps small business to grow, and it bridges the urban rural divide. Yes, there was a gap between urban and rural. There was a gap between urban and rural. This divide was, this gap was bridged, right? It bridged the gap. So let's summarize the fact which we have just now discussed here. First of all, we talked about 1980s to 1990. I told you earlier NBFC number was 7,000 and it grew to 30,000, right? Massive growth. And RBI introduced the SA Reform Committee. Just now I talked about SA Reform Committee. Okay. Then we talked about 1997 rule, in which compulsory registration as per the SA Reform, compulsory registration plus prudential norms were introduced. Prudential norms were introduced. That means limit were capped on how much they can lend, how much they can deposit, everything there was limit. That's called prudential norm. Then the next thing is financial inclusion. What is financial inclusion? So basically NBFC serve the rural and semi-urban area, right? NBFC serve the rural and semi-urban area. Second point is innovation, which means customized loan, digital lending, fights competition with bank, that is called innovation. And if we talk about the big impact, so NBFC help achieve India's banking for all mission. There was a mission that was called banking for all. So NBFC help achieve this particular mission. So have you ever used Paytm Postpaid or Bajaj Finance EMI? So these are NBFC at work. Paytm Postpaid, obviously it is NBFC. Bajaj Finance EMI, it is also an NBFC, right? So this is how NBFC has developed over the year. Now have a look at the next slide, that is MFI. MFI we have already covered in detail in the previous slide. Imagine a small tailor in a village who need 20,000 rupees to buy a new sewing machine. A tailor is there in village and he need 20,000 rupees to buy a new sewing machine. Bank might reject her, but an NBFC backed microfinance institution. So remember NBFC backed, you know about this NBFC MFI we have covered in the previous lecture. So NBFC backed microfinance institution steps in, and we will see how NBFC and MFI are transforming lives in the rural area. First of all, before diving into, let's understand what is MFI. What is the meaning of this microfinance institution? Let's understand. So MFI stands for microfinance institution. Most MFI are NBFC that give very small loan. And if we talk about the range, 10,000 rupees to 50,000 rupees. In this range they provide loan. Who? MFI. So these are kind of NBFC which provide very small loan, right? To whom? To low income group, which we call LIG, low income group. So they are for the poor, right? They are for the poor. First of all. Second point, grassroots reach. You can see keyword written here, grassroots reach. This is the second point, which means that they operate in village, they operate in slum area where bank don't operate. That is called the grassroots reach, right? So let me give you one example. Suppose a woman self-help group in Odisha. Suppose there is a woman self-help group in Odisha. So she get 15,000 rupees loan from an MFI to buy goats. So from MFI they are getting 15,000 rupees loan to buy what? Goats, right? So this is called the grassroots level helping. So I hope these 2 points are clear. Now the question is, how do they work? Have a look. No collateral is required. I told you, na, right? They don't require any collateral. So basically, unlike bank, they trust borrower based on group guarantee. So the key word here you can see, that is the group guarantee. Since group is giving the guarantee, so no collateral is required, as we have discussed earlier. And weekly repayment, which means what? So let me write it down. Group guarantee, this is the first point. And the second point is weekly repayment. Weekly repayment is, that small manageable installment. For example, a rickshaw driver repay rupees 200 rupees per week instead of a lump sum. So effectively we can say this NBFC plus MFI, right? This is a super team, isn't it? This is a super team. So bank struggle with fill the gap. What they do? They use some local agent, right? NBFC use some local agent to understand the need. Obviously, the role of local agent is very much important. So the first point you can see is the local agent. Okay, they offer the customized project, right? They offer the customized product. We can say here customized product. So what is the meaning of this customized product? Like crop loan. Crop loan is a kind of customized product. Petty soft financing, a kind of customized project. For example, let's suppose a fisherman gets a monsoon season loan to repair his boat. That is a customized project. And if we talk about the biggest impact, is the financial inclusion. Yes, they are reaching the unbanked area. They have reached the underbanked area, right? 190 million Indians served by MFI. This is the RBI source. 190 million, commendable. You can see the reach, 190 million. And they also support schemes like government schemes like Mudra loan is also supported by this NBFC. So also already I told you their models are very much innovative, right? Mobile banking is one model. Obviously they are offering loan via apps. Obviously it is innovative. And they beyond loan they offer economic growth also. Yes, they offer economic growth, like they create jobs. How? See, a small business hire locally people and they diversify our economy. So basically you can see their advantages are multifold in terms of economic growth, in terms of financial inclusion, right? So that is the role of NBFC MFI. So let's summarize the key point which we have just gone through here. Just I am summarizing you. First of all, what we talked about, this MFI you can say these are NBFC for the poor. Okay, and hyper local means they use the village group field agent for trust. And the third point I told you about is faster. They are faster, they are flexible. They are faster and flexible. Okay, then we talked about tech plus tradition, technology plus tradition. It means they combine app with doorstep service. And then lastly we talked about the national impact. Sabka Saath Sabka Vikas. So they help achieve this Sabka Saath Sabka Vikas in finance. That is called the national impact. And Bandhan Bank started. If I give you one example of it, so let me give you one example. Bandhan Bank. Have you heard of this bank, Bandhan Bank? Yes, obviously you have. So the Bandhan Bank started as MFI NBFC. They started as MFI NBFC. Remember it. These are the point. These are the nutshell point which I have collected from the previous slide. Now let's switch our focus to the regulators of NBFC. Who are the regulators of NBFC? Have a look. So friends, did you know that not all NBFC are regulated by RBI? Some have different watchdog. Let's break down who keep an eye on this financial player and why some get a free pass from RBI regulation. First of all, let's talk about the RBI regulated NBFC. So the most NBFC like loan companies, right? Loan companies or investment firms. So loan company, investment firms. These are the most NBFC. They are directly supervised by RBI. They are under direct RBI supervision. So what they need? They need RBI registration. And they must follow the strict rule. For regarding capital requirement, regarding audit, etc. Let me give you one example. You might have heard the name of Bajaj Finance. I hope you have, right? So what is Bajaj Finance? So Bajaj Finance, they are RBI regulated. First point. Second point is that they offer loan and also EMI cards. This is one best example to understand RBI regulated NBFCs. Now, besides that, there are some exempted NBFCs, exempted category. So some NBFC are exempted from RBI regulation, but they are monitored by other authority. Who are other authority? Like SEBI, Security Exchange Board of India. So there are some NBFC which are regulated by SEBI. So that is called SEBI regulated NBFC. Like venture capital fund, VCF. Okay, like for example, like if you a startup investor, they are like venture capital fund. Then merchant banker or stock broker. Right, let me give you one example. You might have heard the name of Kotak Mahindra company. Have you heard of it? Kotak Mahindra company. So this Kotak Mahindra Capital, not company, Kotak Mahindra Capital. So this help company raise fund, and they are saving. This is also kind of NBFC, Kotak Mahindra Capital, and this is also kind of NBFC. This help company to raise fund, and this is kind of SEBI regulated NBFC. Right, venture capital fund like a startup investment, merchant banking company, stock broking company. So these are SEBI regulated. They are not RBI regulated. And then have a look at some IRDAI regulated. IRDAI, Insurance Regulatory Development Authority of India, a regulated NBFC. So some insurance company, right? Like for example, LIC. You might have heard the name of LIC. So they are IRDAI regulated. They offer through insurance, right? It has NBFC arm. And if we talk about the state government and MCA, state government and Ministry of Corporate Affairs, yes, some cheat fund are there, cheat companies or cheat fund, right? So these are basically, they offer local saving scheme. They offer local saving schemes, cheat companies. Some Nidhi companies are there, right? So they are state government regulated. So this cheat company, they are regulated by state, and some Nidhi companies are there. Let me write it down. Nidhi companies are there. So basically they are a small mutual benefit company, MBC, a small mutual benefit society. So they are regulated by whom? They are regulated by MCA. What is MCA? Ministry of Corporate Affairs. For example, let me give you one example to make this more clear. For example, a Nidhi corporation in Tamil Nadu, right? They lead lend only to its member. Okay, and besides that, there are some NHB, National Housing Bank regulated NBFC, like HFC, Housing Finance Company. So HFC, for one example, I can give you SDFC Limited. Means before you know it very well that SDFC Limited was merged with SDFC Bank. So before merging with SDFC Bank, SDFC Limited was under National Housing Board, NHB. Then we have stock exchange or mutual benefit company. So they are completely regulated by SEBI. They are SEBI regulated. Okay, so we can see now that SEBI regulation is there, IRDAI regulation is there, NHB regulation is there. Okay, and then state government regulation is there, MCA regulation is there. Now, why different regulator? So what is the reason behind this different regulator? Let me talk about. First of all, specialization. So let me highlight the key points. Why different regulation? First of all, specialization. Why? Because SEBI understands stock, IRDA know about insurance. So that is one peculiarity. Second thing is that avoid overlap. What does it mean? This is another reason why different regulators are there. Means they prevent dual regulator chaos. Suppose one particular NBFC is regulated by RBI also and SEBI also and IRDAI also. So that is called dual regulated chaos. That the chaos will be created. To avoid this chaos, this specific regulation is there. Then local control. Yes, this is super important point. What is the meaning of local control? Try to understand. Cheat fund need a state level oversight due to regional variation. Now let's summarize what we covered in this particular slide. I'm just summarizing here the key points which I have just covered. First point is that we must keep in mind that RBI regulate most NBFC. RBI regulate most NBFC, basically loan company and leasing firm. But there are some exemptions like CV domain. CV domain include VCA, venture capital fund, and stock broker. Then just Mahindra, Kotak Mahindra capital I told you. Then IRDAI domain is there. In the case of IRDAI domain, I told you that some insurance linked NBFC are there. Then state /MCA is there. Basically, cheat funds are there. Cheat fund and Nidhi companies that comes under this. Then NHB we talked about, National Housing Board we talked about. So these are HFC, Housing Finance Company. I give you example of SDFC Limited before merging with SDFC, SDFC Limited. So goal is to ensure that no financial activity goes under unsupervised. So have you ever invested in mutual fund or chit fund? Those are SEBI state regulated, not RBI regulated. Remember it. Now have a look at the classification of NBFC. So friends, you know that not all NBFC are same. Some take deposit, some don't take deposit. Some finance truck, other fund startup. Let's decode how RBI classify NBFC based on their risk, based on their activities, based on their size. First of all, who get free pass from RBI regulation? The question is, who get free pass from RBI regulation? Let's answer this question. So some NBFC are regulated by other bodies. Just now we are talking about SEBI, IRDAI, and they don't need RBI registration. I told you who get free pass. So for example, suppose there is some stock broker NBFC. So suppose there is some stock broker NBFC. You know this stock broker NBFC, they are regulated by SEBI, Security Exchange Board of India. They does not answer to RBI. But beware, if an NBFC does financial business without RBI registration, penalties or legal action will be there, right? Yes, can face penalties and prosecution. You can see written here. So if NBFC does financial business without RBI registration, suppose NBFC is there, they does any financial activities without seeking registration with RBI, so they will face penalty, they will face prosecution. Now let's look at the classification of NBFC. So basically the first category is they are classified on the basis of their liabilities, as you can see here, liabilities. So if we talk about the liabilities based classification, which means do they take deposit? The simple question is, are they taking deposit? Do they take deposit? That is what I am answering. So there are two categories, category A and category B company. Okay, if we talk about the category A, what happened? They take public deposit. If we talk about category B, they don't have public deposit. Two categories are there. That is the liability based classification, right? Category A means having public deposit, category B means not having public deposit, right? So that is called liability based. Means if they are taking public deposit, they are categorized under category A. If they are not taking public deposit, they are under category B. Okay, now so but category A, since they have public deposit, so they have some certain requirement like capital adequacy, liquid asset, exposure norm, regulatory reporting. The second basis of classification is the activity. Means what do they do? What do they do? So the first category is called AFC. You know what is the meaning of AFC? AFC stands for Asset Finance Company. So they fund, AFC fund, vehicle. AFC fund, machinery. Okay, let me give you one example. Like, Tata Capital Finance Truck. Tata Capital, this finance truck, right? And then we have loan company. Loan company, they offer personal and business loan. Like, Bajaj Finance, they offer consumer EMI. Then we have investment company, IFC, infrastructure finance company, that's called IFC. They fund roads, they fund power plant, right? Let me give you one example. You might have heard the name of RFC, right? REC Limited, they support energy project. So this is the second basis of classification. First of all, liability based means do they take deposit? If they are taking category A, not taking category B, then what activity do they do? If they engage in AFC, are they AFC? Like they are financing the vehicle, or they are financing the machine, like Tata Capital is financing the truck. Or are they IFC, infrastructure finance company? One example I given you, REC. REC is the best example of IFC, REC Limited. Then the third classification is size based, which means how big they are. So basically in this category you will heard the name of systematically important NBFC. Like systematically important bank is there, similarly systematically important, so that is called NDSI. Okay, so they have asset larger than 500 crore. They have asset larger than 500 crore. Okay, so they are treated like too big to fail. Too big to fail. Okay, so they have asset larger than 500 crore and they are too big to fail. So they must follow the bank rule. Like okay, what is the bank rule? Like capital adequacy requirement, exposure limit, so they must follow all these. NDSI, right, non-deposit taking NBFC, and that too systematic. SI stand for systematically important, and ND stand for non-deposit. Remember, they don't take any deposit, right? That is ND, and NBFC, you know it very well. Okay, and condition is that their assets should exceed 500 crore. And if there is a smaller NBFC, suppose if there is a smaller NBFC, I told you now, if there is smaller NBFC, their asset is less than 500 crore. So there are fewer rules. Now the question is, why does this classification matter? Because you know, this classification matter because it deposits safety. Yes, I told you now, category A NBFC, right? That they took public money. They are heavily regulated. They are heavily regulated. You know, they are heavily regulated. Category A NBFC are heavily regulated. Then second reason why classification matter is the risk control. What is the meaning of risk control? Risk control means, you know, big NBFC, like, you know, NDSI. This is the bigger NBFC. NDSI can't gamble with money. They can't gamble with money, right? RBI watches them closely. So that is how risk is controlled, because you know they are systematically important. They are too big to fail. They have asset more than 500 crore. So RBI have a close eye on this NDSI. And then the third reason why classification matter is that tailored rule. Yes. What is the meaning of this tailored rule? Tailored rule means a gold loan NBFC has different need as compared to infrastructure finance and NBFC. So let me summarize what we have gone through in this particular slide. Let me summarize. Just have a quick summary. First of all, we talk about the exempted NBFC, right? Exempted NBFC, we talked about they are regulated by SEBI, IRDAI, not RBI. Then we talk about the classification. One basis of classification is the liability type. On the basis of liability, we have category A. Category A means they take deposit, and then we have category B means they don't take deposit. Okay, and since they take deposit, so there is strict rule, and since they don't take deposit, so lighter rule. Okay, now then we also another mode of classification was the activity based. Liability based we have just discussed. Activity based. Activity based, I told you, asset finance. Asset finance, loan, and you know, infra funding. So this is activity based. And size also I told you. Size I told you, if 500 crore plus asset, 500 CR plus asset, they are called SI, systematically important. And for them, you know, there are some extra rules, right? And if there is small NBFC, right, there are simpler compliance. So have you ever taken a truck loan or consumer durable EMI? Thanks. You should thank activity based NBFC. Okay, I hope it is clear now. Now friends, have a look at the yes, so we were talking about NBFC, NDSI, and we will talk about the regulatory oversight by RBI on NBFC. You can think of RBI as a strict teacher of the financial world and NBFC as the student. You know what happened? After some NBFC misbehaved in 1990, RBI got a power upgrade in 1997. I already told you, in 1997, RBI got a power upgrade. You know, power upgrade this RBI got. Right. Let's see how RBI plays referee to ensure NBFC don't gamble with people hard earned money. So first of all, too big to fail NBFC, I told you, systematically important NBFC. So these are NBFC whose asset is larger than 500 crore. Why there are a special rule for them? You will see a word written, a special rule, because their collapse could shake the economy. So RBI had some safety rule for them, right? So what are the safety rule? Let's have a look. So they must keep rupees 15 for every rupees 10, 100 rupees lent. Just wait a minute. I think it is 20, not 15. Presently they can accept deposit, but we are talking about earlier phase. In earlier phase they were not allowed to accept deposit, right? And they were regulated by the Companies Act. Okay, now what happened? Let's go through the history. There were little regulation earlier. In 1970, James S. Raj committee was formed, which superimposed some limits, right? In 1980 and 1990, you can see NBFC boomed from 7,000 to 30,000. Then SA committee reform comes in 1990. which make registration mandatory, and for deposit taking NBFC they have to maintain some liquid asset. And 1997, RBI Act comes into picture, which tightened the control. Right, this thing we have discussed. Then after what we discussed is that 1960, there were some alternative, right? It took deep. Licensing was only offered. 1970, James S. Raj Committee, deposit and safety was ensured. 1990, liberalization, RBI control took over, right? So RBI control took over in the 1990. Then after we talk about 1980, 1990, I told you earlier it was just 77,000, now it become 30,000, boomed in this phase. SAR reform comes 1997. Sorry, because of the SAR reform, complete registration prudential norm was introduced, right? So these NBFC offer innovative product. They offer financial inclusion. They offer rural financial services to the rural and semi-urban area. Big impact was that it offered banking for all, right? Then after we talk about MFI. MFI is the microfinance institution, which is a kind of NBFC for very poor. Hyper location, local. They offer service through local. They are faster. They are flexible, right? And now how NBFC is helping the economy? They offer job, right? Technology first edition. Nationally they have impacted. Example is the Bandhan Bank, which is a kind of the NBFC, MFI NBFC, right? So we talked about, in the next slide we talked about RBI, who regulate NBFC. So RBI regulate most of the NBFC, but there are some other regulators like SEBI. SEBI regulate BCF and stock broker. Then IRDAI regulate the insurance type of NBFC. State government and Ministry of Corporate Affairs regulate the chit fund and Nidhi company respectively. And National Housing Bank regulate the HFC, Housing Finance Company. Example is SDFC Limited before merger. So these are the different regulators. So then the next thing we talked about the classifications. Okay. So what we talked about the classification, just have a look. So we talked about, there are some exempted NBFC. So basically I talked about exempted NBFC who are regulated by other regulators like IRDAI, SEBI, who are not regulated by RBI. Now we talked about the different classes of NBFC. On the basis of liability, there are two categories. Category A means who can take deposit and there are strict rule there, and category B NBFC who can't take deposit, there is a lighter rule. Then we talked about on the basis of activity classification of NBFC. So asset finance company, loan company, infrastructure finance company, right? These are the three classification of NBFC based on activity. On the basis of size, I talked about 500 crore plus asset NBFC, right, which is called systematically important NBFC, and they have extra rule, and there are small NBFC. So these are the classification of NBFC on different category, on the basis of their size, on the basis of their liability, on the basis of their activity. Now friends, in the next slide we talked about NBFC NDSI. ND means not deposit, SI systematically important. They are having 500 crore plus asset. In 1997, RBI Act comes into picture. They offer license, they offer audit, everything. And depositors, for depositor safety, 15% of the amount must be deposited in the liquid asset like the government bond. Government bond is a kind of liquid asset. And for profit control, 20% is locked. Means for any particular NBFC, suppose total profit is 100 crore. So out of that, 20% must be kept. They can't recklessly spend in the entire profit. So these were the regulation which were brought in 1997 after the RBI Act. Especially for NBFC D, that is deposit taking NBFC, this liquid asset concept comes into picture, and this profit control concept is for all type of NBFC. Okay, then after we talked about FPC, Fair Practice Code, comes into picture in 2006. Means no hidden loan terms should be there. Corporate governance picture comes into picture in 2007. Professionalism were ensured. If there is a deposit taking NBFC, for FD minimum 1 year, maximum 5 year, 10 year, and it can't exceed, the interest on the FD can't exceed 12.5% per annum, right? And investment grade, yes, NBFC must only investment grade and graded NBFC can take deposit, right? And there are some risk also involved. I talked to you about risk, that no insurance is there. Like in the case of saving deposit of bank, you will get insurance which is offered by DICGC, but in the case of NBFC, no insurance is there. Okay, so these are the risks that you are exposed to, and that is all about today's lesson. I have clearly summarized all the key facts. Now in the next lecture we will continue with AFC. If you really like the lecture, please hit the like button, and if you want such kind of videos for each and every subject of JAIB, you can WhatsApp me on this particular number. Thank you.